We have a few practitioners, I think. Yeah. Do we have regulators who are working with regulations? Assistant panel. Do you have some people from the press? Okay.
No caveats.
Well then, thank you for your preparation and enjoy the evening.
Yeah, so we have a fantastic panel here, and I'm just going to pass it to the lovely Julia, who will go ahead and introduce the superstars we have for you today.
Can you guys hear us okay?
Yeah.
Well, the title of today's debate is really the unintended consequences of Basel III, but we're not going to talk about Basel III exclusively. We're really going to talk about liquidity and capital requirements that are being introduced across the board in various different guises in terms of regulatory reform. Now, obviously, liquidity and capital requirements is going to have an impact on the bank's profitability, the way that they manage their risk, and of course their business models. But the general aim is really to strengthen the financial stability of these organizations as well as the financial system in a wider sense. So that's kind of my disclaimer more than anything. We're going to be talking about how these different types of regulations really interrelate and the implications of these on institutions and on the financial center. Now, luckily, we have a very good and various panel today that are really going to come from various different perspectives and industry sectors to give us a very well-rounded discussion of these implications. Now, I'm actually going to let them introduce themselves more specifically, but just to let you know who we have on the panel, I'm just going to read them very generally. We've got James Nicholls, who's Director of Risk Management and Regulatory Strategy at Baringa Partners. We've got Dr. Colin Lawrence, Senior Risk Strategist, Prudential Business Unit at the FSA. And we've got Jonathan Howitt, who is the previous Chief Risk Officer, Evolution Group, and Richard Young, Head of Regulatory Affairs for Securities Markets, SWIFT. And last but not least, we have Servas Hoban, who is chairing the CFA UK Economic Capital Special Interest Group and has 8 years' experience working in the insurance industry. Now, Servas comes from the insurance industry. Most of the regulation really impacts, in terms of Basel III, the banking industry, but he's going to give us his perspective as well and pepper it throughout the debate. A couple of housekeeping rules really before we begin. Firstly, we are going to be using Twitter, so if you do want to ask any questions, feel free to use the UCL Fines Twitter account to send us questions via that medium. But I really like it if we can get as much interaction as possible throughout the event. So if you do have a question at all, I would say just raise your hand, identify who you are, and ask away. We'll really take some questions from the audience throughout when there's kind of natural gaps in the discussion. And then the final thing, I don't think there's any media people, any press, but if there are, please do check with speakers before actually quoting them. So that's kind of the housekeeping, and I'm really going to start off with the first discussion, which I thought would be quite timely. In the last 10 days, Basel Committee announced that it's loosening or weakening some of its, depending on your point of view, some of its liquidity buffers and liquidity requirements. So I really want to talk about this first and foremost, and then kind of open that up to talk about more general regulation impacting liquidity. Jonathan, what do you think about this? Do you think the new changes to liquidity requirements is weakening the rules, or is it a realistic change?
I think it's realistic. I mean, you know, the whole premise that government debt is risk-free is one of the fundamental flaws in Basel. So, you know, to alter the liquidity rules to at least allow other assets, albeit with significant haircuts, but at least to allow other assets in the pot helps. And one of the things we learned in the crisis that even government sovereign bonds that were perfectly liquid, you know, 1 week were totally illiquid the next. So I think to look at portfolios of assets from a liquidity perspective is more valuable than simply 1, 2 key categories. So yes, that makes sense. The delay, what can I say? It feels like just giving people more time. Frankly, for the larger institutions, they really ought to be ready now. They're not, but maybe that's the statement, isn't it, that they're not there yet. And then the regional and second-tier institutions probably have even further to come. You know, Colin could, one assumes there are still a significant number of institutions on central bank lifelines, and that really says it for you as to why there are probably delays, and we know the issues in Europe. So I think it's a realistic change, and the industry, I suppose, welcomes it, although if I'm honest, you know, I'm not really a believer in the hard metric. I think it's helpful to say, you know, we've got, you know, LCR, 30 days liquidity, you know, frankly, so what? You know, the problems with liquidity in the crash were to do with business model problems, a la Northern Rock and so on, where, you know, it didn't matter if you had 30 days liquidity or 3 months or even 6 months, you were going under. It was just like a slow train coming at you. So my view is these ratios are of some help in giving benchmarks and putting some very basic standards down, but the real issue about liquidity is a lot more than a few little metrics on a Pillar 1 basis. So
I think that's an interesting point to pick up there, that actually you know, everyone talks about the Basel liquidity standards as if there are simply two of them. There's the liquidity coverage ratio and the net stable funding ratio. There's actually a whole series of additional liquidity monitoring requirements in there. They haven't been particularly well fleshed out yet, and it'll be interesting to see how that evolves over the next couple of years. But that's where the real supervisory review is going to come in, and where firms are really forced to think about their real actual liquidity profile, not just how it looks on a 30-day or a 1-year basis.
Can I just, one thing I'd want to finish on, I don't want to rile anyone here, but I have actually had the pleasure, not at the bank, but at an investment firm, where we had to put in place the liquidity adequacy standards. And like a hospital pass, it was thrown at me from the CFO of the firm that I joined. You know, we didn't have a proper settlement data counting system, so you can imagine how hard it was to get the data. And you got this monster great big spreadsheet, effectively, because it was all, you know, cobbled together, that you downloaded from the regulatory website and just got on with it. And it wasn't particularly well defined where the assets went, so there's a big learning curve for the firms, frankly as well for the regulator on this. And the answer you came up with wasn't a lot of help, because it was literally just you know, if you got it right, a 90-day cash ladder. With some numbers way out in the future. Frankly, from a business perspective, it was more of a cost than a help, if I'm really blunt about it. However, what we were also told to do was write an ILA, an individual liquidity adequacy assessment, which is the liquidity, it's like an ICAP, but it's for liquidity instead of capital. So that was a seriously meaningful exercise, and that was, rather than just a bunch of numbers from the balance sheet, it was much more thinking about stress scenarios, about tails, about, you know, if you had 3 or 4 liquidity events in the space of 3 or 5 days, in a small investment firm, that can break you, because often you don't have the facilities. You certainly can't tap the central bank. So you've got real problems that would come out by analysing the liquidity under an ILA, and we ended up with significant cash buffers to make sure that we were not going to be in a problem situation. So just the basic reporting didn't help us, and the basic metrics didn't help us, but the internal analysis and the scenario and stress testing really did help us, and we were able to bake some of that into the business model and close down some activities and price them better.
Any questions from the audience yet?
Sorry, Jonathan, you mentioned when you first started out your point that it speaks to the volumes that the banks aren't ready yet. What do you think are the implications for that on the wider economy in terms of the global sense, or maybe in the UK sense? So why do you think the banks aren't ready? What does that spell about the financial sector as a whole?
Well, I'm not, I mean, Colin may be the better one to answer this, but, you know, very large banks are still dependent on government lifelines. And as we know here, you know, 2 of our major banks are pretty much government owned or run. And you know, without government help, I'm not sure what there'd be of the building society sector, but I can't, you know, Colin, I don't want to.
No, so I think that, look, I was just to say that after 2008, I was hired to come and, you know, build a risk management group, and one of the areas we put into play was the LRP and the ILAS. Now, Where I disagree with Jonathan is about the LRP not being meaningful. It was incredibly meaningful for the big banks. And what we did really, if you think of the LRP, it was one stress test which we ran, and the other thing was it was standardized in such a way that we could compare where banks were from the stress. So for example, how long would you survive under a condition where you couldn't go to the central bank? How long would you survive if you couldn't go to the repo market? How long could you survive if you couldn't tap any further inflows, etc.? So it was very meaningful, and we were able to compare across banks. So it was a meaningful first start, okay? And I think we kept a very tight lid, and I feel without it, we would not have been able to save the banks. Yes, many went on lifelines, had to borrow from the central bank, and obviously in Europe, had to tap, the ECB, etc. And in the end created another crisis because of that and pulled the government sector into the crisis. But I'll tell you, one of my insights into this was that what I was shocked at was the lack of asset liability management inside nearly all the banks, building societies, etc. Now, history, a lot of people say you can't look back at history because the future is uncertain, so what are you going to learn? But actually you can learn quite a lot, okay? And I feel already in the United States there was the S&L crisis because of liquidity management. Interest rates shot up or were pushed up by the Fed up to 21% Fed funds, and virtually wiped out the whole building society sector. Okay? Now here, the building societies as well, across the board, in my view, did not have sufficient or robust systems, nor did the big banks, okay, have a sufficient structure. And it's not something to put in a room and just run a silly stress test. It wasn't silly at the time, it was to get a benchmark across all the banks. So I see the LRP as the start of something. But because we made it quite tough, because we wanted to get banks much stronger, and we have succeeded in getting banks to such an extent that that's the reason why now you're seeing a loosening, although it's coming from the Basel side. Even on our own side, the Bank of England has stepped in to start swapping and saying, you can, if you lend more, we'll reduce the liquidity buffer. So what that says, it is quite tight, etc., for lending. So here comes another concept, and that is the difference between counter-cyclicality, which is from the business cycle, etc., and the other is resilience. Now, it's unfortunate that in the crisis, which crises usually happen, we fell right into a trough. So both in a glide path for Basel III, on both liquidity and capital, the real issue is to build up resilience in the banks, that they can basically withstand a lot of shocks, different types of shocks in the system, in terms of lending, in terms of unintended stuff that occurs, etc. Defaults, the euro defaults, etc. So that's really the glide path. And I think what happened on liquidity, although we were in the United Kingdom, we were well ahead of Basel, but Basel took a lot of the rules that we put into play, and we made it tight on purpose, etc. But of course, it also meant that we did other things, such as allow the Bank of England's facility, etc. But the bank believed there were two offsetting issues. The one was the counter-cyclicality. We had to give banks more liquidity, and you're seeing quantitative easing go on, and that's to put cash. And then suddenly the liquidity buffer seems the other side. The way to think about it, again, is to say the one's a counter-cyclical policy, okay, coming maybe more from the monetary policy side. The other's a regulatory policy that's designed to build resilience for the future. And taking the point that Jonathan said about the ILAS, really that was for the first time doing deep dive reviews in the banks in the United Kingdom and seeing what sort of asset liability management they had. And I'm afraid to say that I found that actually it was quite poor, relatively speaking. And that also goes into the governance of this stuff. It's not enough just to set up some committee run by the Treasury just go over the numbers quickly and correct to say, you know, 60 days or 90 days we can survive. The real thing is to be able to set up a stress testing framework internally, to be able to look at what shocks you can withstand. And the other point, third, final point I'll make, is transfer pricing. Transfer pricing is really the true cost of funds. Even in areas like derivatives, you'd sort of think, if I traded derivatives, well, I don't have liquidity risk because I'm not lending or borrowing money, I'm just dealing in derivatives, but actually they're collateral movements. So, for example, downgrade. So collateral actually was at the heart of this crisis. There were collateral was necessary because fund managers were worried about banks. When they lost confidence in banks, they demanded more and more collateral. And haircuts. And when the haircuts, you know, went up and they said, right, we'll only lend you X, etc., to a bank. It's like a wholesale deposit. And I think that collateral is not understood, particularly in derivative businesses. A downgrade leads to more collateral. You have to post more collateral with a counterparty. And that led to further squeezes, particularly for, you know, universal banks that are in the trading business, and that's what happened in this crisis. So I'll just say that overall, this current loosening is just because it's two different objectives. The one's counter-cyclical, to make sure that the economy stays on track. The other one is basically we need a new set of rules to ensure for business models that firms have sufficient liquidity in order to survive under very difficult conditions.
Actually, can I sort of build on that? I mean, I think my view would be kind of similar. You know, there's obviously good economic reasons why sort of squeezing the banks too much has a potential negative effect on economic growth, and so that's the kind of the economic reason for being a bit more cautious about how new regulation is actually applied in practice and the speed at which it is applied. Then there's also this issue of other regulation that's coming in that's also forcing a demand for assets, the sort of assets that are being required to be built up to satisfy these ratios will also require for collateralization for other purposes. So if you're involved as a bank in derivatives activity, there's a whole host of regulation in the US, also in the EU now, and similarly in parts of Asia, where, you know, more collateral is going to be required because you're being required to move these transactions through central clearers, which require collateral to be posted and available to them. And there's a view, and the IMF and the people who put it forward, that, you know, the assets that are actually good enough to satisfy, you know, these regulatory buffer requirements, and also the collateralization against transactions that you may want to be doing. Is there enough good collateral around there? I mean, obviously we know that that sovereign debt, which is one piece of collateral that was typically quite popular, is no longer quite as popular as it used to be. So, you know, there is a problem potentially there in terms of, is there enough good assets to satisfy everyone's needs? And if there isn't, then there's a need for optimization as to how you do use the assets that are good enough to the best effect. And that's an operational question, and that's something that that's where Swift comes from, because we actually didn't do our introductions in the end, did we? But I'll just tell you briefly.
Unintended consequences.
Yeah, unintended consequences there. Swift, which sounds like a South London removals firm, it isn't. There is actually one in Southern called Swift. It's actually an infrastructure that's used globally. It was started by the banks, for the banks, but actually now encompasses quite a lot of other types of financial institutions. And it's an infrastructure platform for exchanging payments and transaction instructions, both in securities, payments, foreign exchange, and some trade. So it's part of the plumbing that kind of, you know, sits behind all these movements of related to transactions. A lot of it goes, particularly cross-border, goes over the SWIFT network, and we also supply the platform for the euro as well, the target system between the target 2 system between the central banks. So we're part of the plumbing. So we try to see the operational consequences of regulation and try to look at it holistically. And certainly operationally there is a huge challenge around this to maximise the assets that a bank or financial institution has, to enable it to perform the business it wants to perform, to do the lending it wants to do, and to satisfy the regulators that it's got, you know, the right sort of survivability built into its profile. So a big operational challenge there. Certainly that underlies, I think, why it's a sensible move by the Basel Committee to loosen or relax, or whatever you want to call it, the introduction of these ratios. But it's also, I think, there's this economic rationale as well, which is important. So my answer to the first question is certainly that I think, from an economics perspective, which is actually my personal view, because Schieffer doesn't have a view on that, I think it's a good thing. From the operational point of view, I can see it's a sensible thing, because there is a lot more that needs to be done to optimise the way the bank operations deal with this issue of a crunch of collateral, which I think is one of the big issues coming up over the next few years.
Do you think there's going to be a...
Sorry, can you just introduce yourself?
James Hills, I'm from Lombard Risk. Do you think there's going to be a loosening of the grade of collateral that will be accepted by central clearing in the future if we're expecting a collateral shortage because it's not high enough grade? Then is there going to be a kind of loosening of the grade of collateral that will be accepted?
Well, I think that might happen. I mean, we're obviously already seeing with this move on Basel that there's a widening of the what qualifies. I mean, it's up to the regulators to decide because regulators are actually taking a very close interest in CCPs, particularly because you don't really completely eliminate risk, you move it around a bit, and CCPs are now becoming a repository of risk. So they are being very tightly monitored, certainly in the EU now, more at the actual EU level rather than just at the nation-state level, because the cross-border implications of a CCP going on are pretty immense. ESMA, the European Securities Markets Authority, I think is looking at A, what needs to be cleared, if it's not cleared already, simply cleared, and also the whole risk model around CCPs. So I think it may well be a loosening. I don't know how far we will go. Probably Colin, but maybe as a regulator, probably has more idea on maybe where the direction of that is going and how far we're going. But I think it has to probably loosen a bit.
Yeah, because there's going to be a fight between business and regulatory, I guess, on that with optimisation and things like that.
Second, sorry?
I think there's going to be a fight between business and regulatory with optimisation coming up. What will be accepted and how much it costs to fund collateral.
There's always a constructive dialogue between business and regulatory.
So, in answering this question, look, I don't really know. I mean, quite clearly, Greek bonds might not be a good thing for collateral. Well, if they priced, at 30 per 100, it could be a good deal with a haircut. But let me put it to you this way, okay? The important point about collateral because it's risk. Remember that if you hold collateral, just even as a custodian, if it flows out, it's like a capital, it's like a it's like a liquidity withdrawal. Okay, so there's a price to that. So the first most important thing is to start pricing risk. Okay, of that. So for example, in a derivatives business, even if you're doing a swap or something, or even if it's with a clearinghouse, what is the risk to you that you might be downgraded and you might have to post collateral? That is critical for transfer pricing. So I think the industry have to do that. Okay. There's another issue that's got to be taken account of. We've done a lot of work on looking at, obviously what's important about collateral is the volatility of haircuts and the homogeneity and the liquidityness. Now the funny thing is, you could measure liquidityness by the bid-offer spread. So there's a lot of views on particular types of collateral saying, but look how this performed in the crisis, it's liquid. But the only reason it's liquid is because of state intervention. Okay, so you actually argue certain bonds, okay, during the crisis were quite liquid because the central banks stood by to buy and sell. But the key really, I think, of regulation today is to wean banks off public sector funding. So for example, the new Prudential Regulatory Authority, of which I'll be moving to, the move has already begun, and legal cutover will begin on April 1, is precisely that we have no tolerance for using taxpayers' money. Now of course, people will say, haha, but you're going to be with the Bank of England, and the Bank of England might feel that they've got to do certain operations, etc., for financial stability. But so then it gets on to issues like too big to fail, etc. So when there's a collateral outflow, then maybe the Bank of England would step in. Of course, they're never going to tell you whether they would or they wouldn't. But I think a world in which institutions are financially stable, have enough financial resources, understand the risk management, understand how to price all these different things. Liquidity wasn't even on the agenda. I mean, if you looked at Basel II, you know, there were some things written about like systems and controls, you know, and ALM was sort of in there. But this lies at the heart of the issue. How do you price the risk? If you look at Northern Rock, no transfer pricing. In looking at how you allocate capital or your business model, if you don't understand the pricing of risk, etc. And my final point, of course, what I said before, was about resilience. And it is, the stress testing isn't only from Basel, it's really to ask the question, what would happen under these conditions? And of course, there are an infinite number of conditions. And then to see, think of it as a reverse stress test. When would we run out of cash? Just like, you know, Jonathan was saying, at some point you run out of cash. Let's say under particular stress you would lose a whole lot of business, your custodian business because of a downgrade or whatever it is. What are you going to do now if that happened? Then maybe you shouldn't be concentrated and you make decisions. So it's dynamic and it also builds on resilience. That's the new system. Wean off public sector funding.
I think it's interesting what you say there, Colin, but talking to a lot of our clients, so I work for Baringa, we're a management consultancy firm, we do a lot of work in the risk and regulatory space. Talking to a lot of our clients, actually what they're complaining about is that it's too complex to manage, that the transfer pricing you're talking about and getting incentives right, there are so many different parameters now on their business, it's too complex for them to manage.
Okay. So if they say that, and look, I admit to, it's something we probably will get to, I chair a lot of CRO roundtables and they told me we're getting hit by 29, you know, big regulations, so we can't deal with it, it's too complex, etc. But the real truth is that if you're in financial services, financial intermediation, and Solvency II will be on the road for insurers down the road, you have to understand those risks. And if it's too complex for them, I don't buy that. They shouldn't be in that business.
I'm afraid I completely agree on that. It's a difficult thing, and it's one of the key problems that banks have. They built up businesses, and look how much money I can make. But really, these guys had a free ride on two things. You know, all these big traders had free ride on one, bank's reputation, and two, bank's capital and liquidity. Yeah. And they had a field day because most of the time, none of that was priced. The reputation of the institution wasn't priced, the capital wasn't priced properly, and absolutely certainly the liquidity wasn't priced.
Yeah,
so when I hear a client, and especially the big ones, oh, it's too complex.
Yeah. They shouldn't be in it then. If you do not understand it,
Quaku Adeboli had 12 billion of losses, and UBS doesn't know it's lost 12 billion. It's not like they were not priced. No, that was the result. At one point it was 12.
Oh, okay.
And they still didn't know that until afterwards.
Rather put option on a hedge fund, etc. And say, well, actually, we didn't understand what they were doing. It's not good enough. You have to I mean, this is a key really to risk management, lies at the heart of risk management. You should not be in any, and when we talk about risk appetite, a term that's thrown around, it's not a number. It actually is what businesses you're willing to be in. And if you want to be in financial intermediation, you have to understand appropriately what are the risks that we're in. So those clients, could I have their names, please?
I think one thing I'd say, because obviously I'm not sort of offending financial institutions, but I mean, I'd agree, obviously, you can understand your business. I mean, who wouldn't agree with that? So I think what we also are facing, or the financial sector is facing, is a lot of regulation all happening at sort of similar times, and overlapping in some areas, being differently implemented, tweaked here and tweaked there between the US, the EU, and parts of Asia. And if you're a global institution, you're going to have to see what the difference is between the way that they're telling you ought to do your derivatives, your swaps activity in the US, and the way you should do it in the EU. And then they can't even agree as to where the join is in terms of the extraterritorial aspects of regulation, which is a big issue certainly between the US and the EU. So I think there's two things. I think yes, the industry has to make sure it knows what it's doing and has to be ready to be, pricing its risk correctly and accept that. I think also we need to have a sensible regulatory implementation that basically doesn't underlap but overlaps smoothly, rather than the moment where I think we've got too many things, too many moving parts. And I think that's why, going back to my previous comment, I think it was good that, at least with this Basel change, a little bit of thought is being given to how this is actually implemented, rather than trying to do everything all at once and having consequences which indeed probably will be unintended.
Now, let's go a little bit more focused now on some of the impacts on certain firms. And Sir Voss, you represent the insurance industry, and obviously there's multiple different types of regulation that's impacting liquidity, one of which is Solvency II. Would you like to kind of give us the major impacts that you're seeing from your point of view?
Yeah, I think liquidity is a little bit more in insurance, especially in life insurance. So suppose you have a pension product, also pay premiums while they're alive, and once they retire they actually get benefits. As a result, liquidity is not really a hot issue. For example, the current Solvency II standard formula doesn't require a capital requirement for liquidity on the Pillar 1 basis. It's only on the Pillar 2 basis when a company actually assesses its own capital requirements and taking into account liquidity risk. That said, there's still some issues. For example, we saw in the financial crisis that some countries had issues. For example, in Ireland, the equity markets dropped by 73% in 2009. As a result, a lot of companies actually had to go to the regulator. Something similar happened in Holland, where companies invested in Spanish property. It's actually quite interesting to see that the different speed at regulation is also in insurance. So we see that Solvency II is being implemented within Europe. It's a capital-based framework, so we try to have a wide range of scenarios, do all kinds of stress testing, all kinds of scenario testing, and based on that we can come up with a sort of framework that we want to manage our business with. However, there are also other regimes, for example the current US regime, and that use more like a factor-based approach in which you don't really use a full scenario scope. So yeah, just summarizing, is from the Solvency II perspective is less of an issue. What potentially is interesting is that Solvency II will be implemented in January 2016, and it's quite interesting to see if there are any sort of arbitrage opportunities between the regulations from banks and insurance companies that would allow swaps or any other economic mechanisms to be put in place.
On the point of regulatory arbitrage now, we've kind of talked about this very loosely already, but obviously there is the capability from a capital perspective that some banks will move regions literally for the advantages of capital treatments because there is a lax in certain regions for regulation. US isn't so close to following Basel III, for instance. James, what are you seeing in terms of your clients thinking about this?
I think that a lot of our clients would traditionally have tried to optimise. They wouldn't talk about arbitrage, talk about optimising their business model to take advantage of maybe different regional differences. I think one of the things that we're seeing complicating that now is actually the move towards subsidiarisation. And so, as Colin was talking about previously, regulators are now pushing firms to ensure that they have adequate capital and liquidity resources, not just for the group as a whole, but for each of their key subsidiaries. And that subsidiarisation, that trend towards ensuring that resources are held not just at the group level, but in each of their key jurisdictions, is going to prevent some of this arbitrage we're talking about. You're not going to be able to base yourself in a low capital or low tax or low liquidity regime and then operate across the globe as effectively as you might have been able to pre-Lehman's. I think the Lehman's example is one of the things that the regulators are thinking about, which is driving this push towards subsidiarisation. I think we're seeing, we're going to see a lot of unintended consequences as a result of this as well. As we, sorry, Jonathan.
You're right. I'm just going to say, it is the way it's going, and subsidiarisation is clearly necessary. You just have to look at the Lehman's $5 billion that disappeared, on Friday night to know that, directors should be sitting in jail for that. But yeah, it comes at an enormous cost because in the 90s I was at, we didn't give our resumes, did we? I was at Swiss Bank, and which then became UBS, And the impetus was get everything in a branch, shove it all to London. You know, we don't want multiple booking centres, we want it centralised, it's efficient for capital, it's operationally efficient. And the other thing, once you create a subsidiary, you create all these little management tiers of little, you know, tin pot dictators out all over the place that, you know, so managerially it becomes impossible to really run a global bank if you've got multiple subsidiaries all over the place. So managerially, operationally, capital and liquidity, because you're locking up capital and liquidity on them. This is a very high price, but it's the way it's going. Live with it.
Okay, so you say it's a high price. Okay, so let's put it this way. You're a global head of a business and you're sitting in New York. Okay, you got subsidiaries, branches all across the globe. And you don't care actually unless you charge for where you're booking your stuff, etc. So actually what's landed up is you get this complex web. Okay, if you ever looked at any of the big banks, just look at a drawing of their legal structures, etc. Okay, this is what happened with Enron as well. You don't really know what's going on. Now we didn't talk about our backgrounds, but I ran derivative businesses at UBS as well. I didn't know Jonathan there, but was on the other side, you know, poacher, you know, gamekeeper, but was a poacher. And you know, but basically, there's no incentive for me to put my stuff here or there. I just cared about what my aggregate position was. And that's what I looked at. I didn't, you know, care whether the securities were put in Delaware. I didn't care about where my capital came from. Now, actually, that's not a social optimization at all, because all you're doing is you're just moving capital through the system. You're moving liquidity for the system. You're leading to much higher complexity. Although Jonathan said that operationally it would be harder to subsidiarize because it leads to bureaucracy, etc. But there's a cost. If you want to operate in London, for example, you realize that under current rules, we've got a college of supervisors, but if there's a branch here, we actually, other than conduct risk, we've got nothing to say. We can't measure their capital. We have to go to their regulator, either in Switzerland or the United States or wherever that branch comes from. So obviously the whole concept of a branch, okay, is a difficult one, and I believe that's right on the agenda, because what I said to you earlier was that the Prudential Regulatory Authority and other regulators want to be able to resolve firms if they're about to fail. So we're setting threshold conditions, which are usually, some of them are Basel conditions. They come from a barrage of stress tests on liquidity and capital, and if you don't meet them, plus all the other stuff like governance, risk management, competency, financial resources, if you don't meet that, we move you into a score. You know, it goes from, it's called an intervention by the PRA, and at some point we'll resolve you. And resolution is really about closing down an entity, okay, without any loss to the, and obviously making sure that the depositors up to whatever it is through the compensation scheme get paid out, but that you can be resolved without any financial stability impact. Now, understand that if we continue having branches internationally, that actually puts the country at risk, because the fat tail of failure is being paid for by you and me as taxpayers. We're going to bail you out. So that's the reason why we have to have some control, every regulator, because otherwise we depend on, you know, the goodness of another country, and that gets to beggar thy neighbor. Every country says, well, of course we'll work together to resolve this, but in practice what happen, okay, that doesn't happen in practice, because each country has to maximize, okay, its, even regulators, the social utility of its country.
I mean, subsidiarization is a form of protectionism that is a cost of the crisis we've been through. We just have to live with it and
well, it's a benefit as well. It's a cost benefit. It's a cost, but the
net tail risk.
Yeah, it's against fat tail risk. But if I've said that taxpayers will not, if the objective of government is not to bail out any entity, okay, then what are we trying to do? That's why we want the resilience, which is to build up capital buffers, liquidity buffers, do business you understand and can identify the risks, etc. have, you know, good management, and that comes through our interviews for significantly influential position, and run a proper business. And that's why the business model is important. Now, this might appear to raise the cost, but actually what it's doing is reflecting the correct cost, which is the fat tail that would occur under insolvency. So I believe that risk managers missed a trick, and that is they always thought that, you know, usually more in terms of normal distributions and things are normal. And if the world is normal, yes, you can save capital, you can move capital, it can be fluid, it can go from country to country. But when you get into a crisis, which is the real issue, and why often we have, you know, much more severe business cycles, that's what, you know, government is there to do, and that is to protect taxpayers at all, you know, as best as possible. So where I disagree with Jonathan profoundly, it is a cost during normal times, because it's much more expensive, but during a fat tail, it's much easier to resolve and less burden.
Another one of the costs of the firms another one of the costs that the firms are complaining about at the moment is the cost of implementing the resolution and recovery plans. And I noticed that the FSA were commenting, I think it was in December, to firms about how they still have a lot of work to do in terms of developing effective resolution and recovery plans. How far do you think we are from actually being in a position where you can resolve a firm without cost to the taxpayer?
I think that, you know, we're in transition. We're unfortunately now in transition at the worst possible time, because we have not come out, we're not in a recovery mode. This is why I said there are two offsetting factors. One's the counter-cyclical, we're in a business cycle, which puts a lot of pressure on the firms at the moment, you know, because the firms' profitability is much lower. They're also in a deleveraging and de-risking position. And what the regulatory community and government want to do is to build, you know, the resilience I'm talking about, okay? So, of course, firms are going to complain. They're getting hit by all of these things. And therefore, what I think is important, though, is the glide path to these things. I don't think it's a good idea to necessarily just shove the banks with all these things. I think it's something over time. And I think, you know, my own personal attitude, I can't speak for the whole of the Financial Service Authority, would be that a firm demonstrates not that they've ticked the boxes and we've got this group and we've built this. You often see this. It's what I call basement regulation, and that is you come up with a plan, Basel II, and then you buy software, you hire a bunch of engineers, I'm sure a lot will graduate from here, you put them in the basement of your firm, you crunch numbers, and you send a regulatory report, and you're done with regulation. That's not what recovery and resolution are about. It's really a new mindset about thinking about the business. Now, I agree, if you just do a little exercise just to placate the regulator, I think that's the wrong approach. I think the correct approach is, right, we basically don't ever want to be resolved. That's terrible. We lose our business. We want to survive under strenuous circumstances. So what we've got to do is contingent planning for most possibilities, etc. Continue working out what you would do, how you would recover under certain circumstances. You yourself should be led to the view, you know what, it's much easier to resolve a subsidiary than having a whole branch network with back-to-back derivative transactions. We've got banks, for example, that book their stuff in London, they're a foreign entity, and actually control it from yet another entity. So just think what happens in a crisis. How could they have recovery plans? Is there going to be a flight, you know, from country A to country B? How's the regulator over there going to deal with it? You've got different legal netting requirements, jurisdictional requirements. So I think firms, it needs a new mindset. Julia started off by asking about regulatory arbitrage. It's a dumb idea. It was an idea from the 90s where whatever you got away with, you did. You created as much opacity as possible. You didn't care about the fat tail because too big to fail, the government will bail you out. That's exactly what happened. The new mindset is optimize your business model, and I agree with that. You know, it is optimization. How do you make a rate of return on equity capital, and also make sure that all the risks are correctly priced into the model and run all the stress tests necessarily, because that will basically help you to resolve your firm if that did happen, or prevent resolution to begin with.
On your point of basement regulation, one of the questions that I get a lot is how can firms go beyond just compliance to make sure that they're profitable? Because ultimately, you know, the motivation for recovering resolution planning and avoiding, you know, a default, of course, that's great and that should be the aim. But banks are banks. How do they motivate themselves to make sure that they maintain profitability rather than just focusing on compliance?
I think they've got to change the culture. I think there needs to be a real cultural revolution in banking. I think that if you look at banks, you know, when we got into derivatives, and I admit, you know, just talking about my background, I was an academic. I taught at Columbia University in New York, and we were really doing a lot of financial engineering. And I was at a lot of firms like Drexel, Burnham, etc. And I just saw the movement, what happened. Okay, we had the crisis in '87, but we were building these derivatives. No one cared how it was settled, etc. No one even spoke to back office people at all. No one cared. We brought in technology. We developed software. So what we were doing, actually, I'd say, as in a generation, is we built up all these derivatives, etc., always justifying how important they are for our clients, etc. Meanwhile, we were raking up money, billions, etc. And in the end, we've lost it all, okay? Because it wasn't done with appropriate culture. Fixed costs weren't taken account of. You know, and there's a theory of externalities. How many of you studied it? Anyone taken economic costs? Okay. It is very basically, it's the example given by Ronald Coase, okay? Ronald Coase was professor at University of Chicago, my alma mater, so I didn't bring it up because of that. But Coase's theorem basically said as follows. If a guy goes rowing or goes to catch fish, he hires a boat. He pays a fee for the boat, he goes out and he catches fish, and everyone else does exactly the same. Okay? So what's wrong with that? Anyone think that's wrong for fishing? You're paying for the boat, you're going out at sea, you're fishing, what happens? Yeah.
You're not paying for the social cost of...
What social cost? Why is there social cost?
You're depleting the ocean.
You're going to wipe out, okay? You know, you're going to wipe out future, you know, fish. You're going to wipe out the supply of fish because no one is pricing in the fixed cost, so you're operating at average variable cost rather than average cost. And that was his key insight, because no one is looking at the depletion of the fish. So what's the optimal solution? You charge a fixed cost to actually go out to the ocean. So that's why you get permits, or you pay the cost. Now, it's exactly the same in banking. My own view is that particularly traders came in, never paid any fixed costs. They just came and built software, great financial engineering. I honestly think high-frequency trading is probably in the same remit, because they're big problems in the end if it fails, and I realize UCL are in that, so I'd like some debates, but it's in the same vein. What's the fixed cost of this, etc.? What's the social, has it got a social purpose? And I only think that a cultural change that takes account of its impact to society, which is the maximization of social utility. That's the reason why there's financial intermediation. And all these guys that are bitching, etc., go and ask them and say, are you actually creating or depleting social utility?
I think there was, it's fair to say that pre-crash, it was an impossible question to say, what if the bank goes bust? Because the view from even the non-execs said, well, then we're all out of a job, aren't we? So it was dismissed that way. It was, well, it's all over. It's like the nuclear bombs landed, so we don't have to worry about that.
End of the world scenario.
Yes, so as a risk manager, it was a question you couldn't ask. And actually, I think it's one great good the regulators have done is come in and say, look, you have to plan your own death. You know, you have to plan your living will. And because it means then suddenly you can ask that question. You can stress test to destruction or reverse stress test. And you can find the breaking points. And any engineer would be expected to do that, right? You know, at what point does this component break? It wasn't being done in the financial sector, and Colin's right, it wasn't being priced. anyway, that's
I
sorry.
think also the
Yeah.
willingness to break is something that we may need to see a cultural change on. Actually, if firms went back to thinking more like owners, so if bank managers thought more like owners and it was their own money at risk, going back to the old Wall Street partnership model perhaps, that could be one of the cultural changes that we see. I don't think it's something we'll see in the next couple of years, but maybe over the next decade that could be something on the horizon. That could be something that's healthy for part of the industry.
And what about the rise of the chief regulatory officer? Is that kind of a new role that you guys think might, not going to address the social change that needs to happen, but maybe kind of get a bit more senior buy-in in order to kind of facilitate change?
Well, that would be Hector's hands.
Well, I can't comment on my man. I've got two. One is Sally Dewar, who went to JPF as the managing director and board member, and the other's Hector. So they've moved into the senior regulatory role. So
I think the reason why they're moving in is because obviously the firms are seeing that it's a priority, so that they're prepared to hire in someone in that case £3 million or whatever it was. We'll quote the newspapers. I'm no privy to it.
Swift said he sees all the transfers.
Yeah, we have to say who's going to whom and what's going to where. But no, I mean, I think it is the firms. I mean, we're seeing that in terms of the operational level, firms are spending now on operational solutions to regulatory challenges in a way maybe they didn't sufficiently in the past. So I think the priority, to answer the question, seems to be there from what I can see in the financial firms and the banks, both to get the technology right to handle these issues better, and also probably to get the people right, so they've got the right people in the right places to understand what's coming down the wire, and also to make sure that the senior management is getting with the program in terms of compliance. So I think the fact that your colleagues are going to some of these banks at certainly quite nice salaries is an indication that there's a prioritisation there for the chief risk officer in financial firms.
I think the chief risk officer is the person that, to me, is accountable and responsible to identify what the risks are and to come up with how they fit into the strategic plan. Whereas the chief regulation officer is now, a new role. It's just taken like a compliance role to a higher level. But actually,
regulation, not less, sorry,
I've spoken a lot over like 4 or 5 years to Hector. And I know that a key thing, and it is the plank of the Prudential Regulatory Authority, and Hector was behind the actual DNA of what the plan is. And it's very different from how the FSA were. Hector, in the last 5 years, has really transformed, or did transform, the FSA into being a much more lethal with teeth body, as you're seeing now, etc. I think that a key thing is, and an important thing, what Hector always said, and I think this is important because it's the theme of the PRA. The PRA want to know that you're well run. A bank is well run, that it's got a good business model. In other words, the business model is actually right at the forefront, everything. What's the business model? How does it work? If you've got this capital buffer, this liquidity buffer, can you survive under stress? And just under normal circumstances, can you make money? How do you make money? That's number one. Number two is, what at the moment are your 3 or 4 real big risks? At the FSA, what was done, and what banks did as well, is look at hundreds of risks, rather than focus at the top risks in the firm, etc. So I'm still not seeing it in action. What I see, stuff coming my way across the banks. But that, to me, is the chief risk officer has to do it. So, for example, conduct risk, AML, which is anti-money laundering and things like that, are very important, because they can destroy the reputation of a bank and so on. There have been incidences, rogue trading. It's got to be on the agenda of the CRO to know that risk. Now, I've asked chief risk officers this question. In your risk enterprise strategy, are you taking account of these conduct risks? Now, when I ran the stress testing at the FSA, I was quite shocked myself when I saw PPI claims and mis-selling under stress testing came to massive numbers, okay? They were put in by people estimating how many people would claim. And the numbers were staggering, and it reduced, obviously, core tier 1 capital, which we're trying to increase. It's actually the interlinkage between conduct risk, and there's now going to be an agency fully focused on that. Those guys are going to be looking at every type of mis-selling, etc. So the chief risk officer has got to take on board that. I think the chief regulatory officer is to make sure the RDR, which is the new way of commissions, etc., it's trying to get incentives aligned properly. I think that with all of that, between the chief regulatory officer, and maybe that's just a new role, maybe he would have been a compliance officer at low levels, now become a senior executive, and the CRO, they've got to pull all that information together and see where they're vulnerable. I think that will be the new paradigm that we're in.
Okay. I haven't asked if anyone has questions for a while. Any questions before we go into our final question? No?
Yeah, can I answer?
Sorry, can you introduce yourself?
From the Association of Corporate Treasurers. So our members are effectively customers and users of the banking system. And the conversation this evening has been very much around the resilience of the banks, that they don't fail and end up as a cost to government, which is absolutely right, and we'd all support. But there is the other side of the equation, is if the banks are tied down too much by regulation or not being allowed to take risks or not having sufficient capital to do so, it acts as a drag on the real economy because they can't lend. So there are other things to be balanced against the riskiness and safety within the banks. And I just wonder if the panel has any thought on how we ascribe some value to that.
Well, I mean, I think you're absolutely right, and it's a point I made earlier about, the reason why I think they've moved these ratios around a bit is to start to address some of that, because as I say, if people start having to sort of husband together loads of assets and basically they aren't able to do as much business as they did before because of satisfying these sort of ratios and building up capital, etc. Then obviously there is a potential effect, and I think obviously you also, I think what was good about the announcement was that they said that in times of stress they could actually use some of these assets so that you didn't get this awful situation whereby there's a crisis, so people have to sort of huddle down even more, and then that exacerbates the crisis because everyone just clams up and there's no lending to anybody. And that we saw that how that happened in 2007-8, and that was pretty disastrous. So at the extreme level you've got to prevent that happening, but at the normal business level I think you've got to make sure that there's not just a complete focus on regulation and complying with that at the expense of actually serving the real economy, which is of course the most important thing that banks and financial institutions are prepared to do.
Well, there's another argument though, and I speak a lot. I mean, this is a true point that you're making. As I said, the banks are getting hit by 29 major regulations, probably CRD4, Solvency II for insurers on massive changes, etc. But also you bring in Vickers, you start looking at all these structural reforms and so on, and subsidiarization and all of that. I agree with you. But when I ask actual, so it should be what one's got to do is to look at. It's almost as though the Basel Committee or BIS or the IMF have to say these should be implemented along some glide path that will only kick in much later and should only start kicking in once the economy recovers. But on the other hand, I should say this: a lot of it, it's about causality. I'm not a big believer that because the costs of financial intermediation have gone up, that banks aren't lending, just for example. Okay, the real reason, I get this, from a sample of chief risk officers, they're saying it's just they don't want to lend to anybody. It's not the cost, etc. They say they can make a lot of money from lending to primary mortgages, make a lot of money. The books turn over about once every 10 years. So you can work out that 10% of the book is very profitable for a lot of banks. Some trade finance deals, they do it. But by and large, the real problem is, although it could be blamed, you know, you sort of want to blame someone, so, you know, blame the regulator. I mean, the real truth is the economy. It's the economy. And it isn't an interactive situation, but I don't believe it's caused actually by what regulators are doing as badly as they might be implementing it. It's rather, we are in a real, if you go to corporates, okay, it's nothing to do with banking. Corporates can do their own financial intermediation. They can issue commercial paper, they can issue debt. In fact, right now, there's a massive appetite for debt. If you've all looked at you know, credit default swaps, etc., go and have a look at high yield bonds, etc. They've just collapsed in yields, etc. These are credit spreads. So there's tons of financial intermediation if they wanted it. So why don't they want it? Don't have confidence in the real economy. And I think that if the real economy starts moving, which is a confidence issue by and large, okay, not only a government one, I think that you'll start seeing the actual regulation become more marginal, and then the regulator should focus on getting this structurally correct. In other words, don't come in, and I agree, look, you can't hit a bank with, you know, that's why you're reaching all the complexities, because there are too many of these regulations, you know, they're tough, etc. But longer term, I think, you know, we should get there. But it's the economy, the real economy.
Alejandro, student UCL. So the financial crisis in 2008 wasn't the start of this, because there were previously lots of other problems like Enron and WorldCom and the dot-com bust, and then before that LTCM. And do you think if the laws had been different and lots of bankers had been put away for negligence over this period, that the risk management would have been improved in the institution?
It's only one deterrent. I mean, there's a judicial system, okay, in each country, and their criminal laws, etc. So you can't, you just want a change of negligence, right, for, you know, directors. In fact, the one guy, Enron, was actually, wasn't he indicted? And what's his name? Yeah, he was. But your point's, it's a good question, because here we had this. We've had an S&L failure. We had long-term capital. Okay, we flew a plane in 1993 into the World Trade Center, etc., and we actually see events happening, but do nothing about it, actually, if you think about it. So there's been a lot of events.
I think there was denial, Colin, because, you know, yeah, we've been around a bit, right? I was there in '87, I lost money then, all right, and we were there, you know, LTCM, I remember being on the trading floor on the absolute look of terror in 98, as they said, there is no bid in the market. I said, can't be no bid, surely you have 30 cents on the dollar. No, there is no bid across the whole fixed income floor. Absolute terror. And it wasn't very expensive to basically rescue LTCM, was it? I mean, there was a life fund, they all put in a few hundred million, and it was done, and the whole thing just bounced back. And there was the Asian crisis at about the same time. So these things do happen, and I think therefore there was a degree of denial. There was, I remember late '07 thinking, well, it's going to be a bit rough, but nobody really saw it, even in the summer of '08. I remember Oliver Wyman standing up, they've done all the numbers right, it's a $500 billion profit, that's subprime, done, dusted, because we got the money, write the check, move on. The whole thing was tainted. And I don't think people even by June '08 realised just how severe and systemic the whole thing would be. So when you go back to should we lock up the bankers, I think they really didn't think it would happen. And I don't think the central banks did either at the time.
I mean, one thing I would say, as I'm just speaking personally, not on behalf of my company, but on this, because we don't have a view on this either, but I mean, my personal view, the question I'd ask you is, what would you have locked them up for? Take Northern Rock. What would you have locked Adam Applegarth up for? And when would you? Okay, but is that right? What would you?
Model risk as a normal distribution, and I don't know, if you use value at risk, so you shop it for less 5%, you might deliberately fail in what you're doing because you're interested in that 5%. Actually, you're interested in the bank crashing and going completely bust. So obviously, that's completely incompetence. and someone who's running that and isn't running these other exercises already. I mean, you were mentioning these liquidity assessments, and then you were mentioning that your clients were complaining about having to implement all of these things. Well, shouldn't they be implementing these already?
I think so. There are some corporate governance issues which obviously, you know, need to. I think people have looked at this, and you know, the way that boards are structured, the way that you know, they do or do not put a brake on chief executives or whatever, is something that I think you know, has been talked about a lot. And you know, if there was a better, more robust structure around some of those you know, governance structures in some institutions, some of these things might not have happened.
But we have to understand
so that's a possible
time to
less
make hay when the
draconian
sun's shining.
solution.
You know, I mean, the CEO who was the bear during, you know, the 90s and early 2000s probably was not going to keep his job. You know, the boom was on, make a feast. The shareholders look at the governance structure of public companies. Right? This is the big question, isn't it? Public companies are extremely risk hungry. They want results every 3 months. They want a profit. A CEO who doesn't do the risky thing and chase, you know, the market share is going to get kicked out. And this is the problem. We've got nothing in between the public company that's highly risk hungry and the government sector that's totally, you know, utility focused. And this is the dilemma. There's no middle ground. Maybe it's the owner manager whose own capital is at risk. Maybe that is the model, because quite often we didn't see these problems with sovereign wealth or people who own their own.
Skin in the game.
Yeah.
If you had skin
But I
in the
mean,
game.
you're making the right point for me. Because you're saying the guy is saying, okay, well, if I don't do this, I'll lose my job. But if I do this, I'll go to jail. He won't do it.
There was another question back there.
Yeah, I mean, could you include the central banks in that loose monetary policy? You could say that we've inflated bubbles all the way through. Property.
Now there must be a blame. If I look at
The
it
bond
back,
market now.
well, I can't say this about it, but I mean, if we look at monetary policy, for example, and go back to see what Paul Volcker did, and I think probably one of the greatest central bankers, because if you noted, after '73, after Bretton Woods, okay, the dollar basically was readjusted. It used to be $36 an ounce, and it shot up to that time $70 or $80. And just pumped so much liquidity into the system, and this went on, and suddenly we were in inflation, of course, because the dollar was a unit of account through the globe. It spread right out into the United Kingdom and other countries. So you also had inflation over here, okay, and it went on and on and on. And actually, when you look back and you saw, wow, you know, in the early 1950s, Treasury bill rates were 2%. Well, by 1978, these were in the US, they were like, you know, 12% for a bond or 13%. So Paul Volcker actually changed the dynamics for a generation. He actually raised interest rates on a permanent basis by just chopping the money supply, etc. Rates went up drastically, and people thought inflationary expectations would come down. Well, they didn't at first. People are very stubborn. I know dealers basically put on bets that bond prices would go down as inflationary expectations fell. That only happened like 5 years later. So if you're a proprietary trader and you basically went long bonds, you would have got buried for quite a while. But eventually you would have been deadly right. And that whole period to the present, okay, we had low yields, and we're still there, but now we're pumping money in. So a risk I see is that although I'm quite alone on this, etc., but as I said, I was schooled in Chicago, and I had Milton Friedman as a teacher, etc., and you look at his history, you know, inflation at some point will kick in, because you're pumping just bucket loads of money, etc., and for this crisis, the quantitative, it's even more money pumping out.
It worries me because I don't know if I'll be able to put a lid on it when it actually happens.
Yeah, and it should be, and I think it is. I consider that a financial stability threat. The Financial Policy Committee's, you know, got to look at that, but right now it's just trying to keep the patient, you know, alive, etc. And that's why.
The problem with the transmission mechanism, they put 400 billion into this economy, but it's just sitting in the bank vaults in Brazil. It's not going out. You know, it might be better than his helicopter the money.
Yeah, you helicopter money.
I'm ready. I'm ready.
But when the banks
but when
are
supply hits
reserves,
demand,
aren't they?
you'll
So,
get
you know,
inflation.
Yeah.
that money
It will be very hard.
Swapping it.
I think we have one more question, time for one more question.
No.
Yes, can you introduce yourself?
Hi, I'm Andresa Barbosa, currently on garden leave from Citigroup. So my question is basically on concentration. I mean, you talked a lot about preventive regulations, but how do the regulators model their process so that conflicting objectives are tackled? For instance, a lot of prudential regulation actually are not able to be met by a lot of the players in the industry. So what we see is very few players who can meet some of the requirements. And on derivatives clearing, for instance, before we had a market with a client trading against 15, 20 counterparties, and in the new model, it's going to be much more concentrated in 2-3 clearing members that are centralized into a clearinghouse. So during the regulatory process, how these objectives are actually modeled and taken into account, and where to avoid the too big to fail scenario that you mentioned.
Well, look, on the barriers to entry, I mean, you know, we have a lot of debate on making sure all the time, even like on Solvency II for insurers, try and make sure that, you know, this doesn't only play to the bigger players. So that's why, I mean, the Basel Committee or Solvency II, you've got to go on a standardized approach. But the mistake is, in smaller institutions, pricing risk is a complex business. So I also wonder myself, you know, how does a small society, unless it stays in very vanilla products, and in fact in both the S&L crisis and in the crisis here, building societies suddenly moved into, some of them moved into commercial real estate. What were they doing? What were they thinking? You know, mutuals going into commercial real estate, and the S&Ls buying junk bonds, okay? So I'm not sure that having lots of little players is necessarily a good thing. And on your second question, well, the clearinghouses really should be a utility. I'm not saying that the governance model is necessarily the correct one where banks own it. The banks will argue that they can operationalize, you know, the collateral better. So I'll rest that, but just think of it as a social utility for lots of players. That anyone can go in there and, you know, clear their securities, put up margin, and generally it should be cheaper because, you know, you can net your positions, etc. than dealing with different banks. So, but I think on your
utility as well.
Sorry,
it's a complex utility as well in the sense that it's also managing risk, and you're going to have the whole deal of managing collateral, the whole deal of.
Agreed. I don't disagree with you, and I also think on your third point about the concentration of big universal banks. Okay, the issue I think is that they will be difficult to resolve. You know, so we spoke about subsidiarization as one solution. So maybe if you're international, you just have a subsidiary, but there are going to be administrative costs and all sorts of things of that nature. It might be complex, and I think that if it did get into trouble, the government would be challenged to bail it out, just like Greece. In fact, under EU, you look at the Maastricht Treaty, what it said is that your fiscal policies, if you join the euro, must be harmonized. Well, did people harmonize? And in the end, Greece are bailed out, and it could have happened to Spain, Italy, and so on. So I do think that probably simplicity and smallness are probably attributes that could be quite important for financial intermediation. I myself have done, you know, quite a bit of research on economies of scale. And I don't see, other than in the settlement area, settling vast sums of money overnight, okay? I actually don't see economies of scale by having 100 branches, okay? So I think that banks should become smaller, focused on certain areas at which they're good at, building up their capital, liquidity, good risk management, good governance, and keeping it as simple as possible. You know, I just think that will be a much better paradigm. So you're able to resolve them. If they did something stupid, or something wrong. And the same concentration is on risk factors. This crisis was about a concentration of real estate as a risk factor. That's what happened. And no bank even ran a stress test to say, if property fell by 30%, what would happen? Didn't even run it. The biggest banks did not have that stress situation. And they were loaded in this, concentrated.
Yeah, but that's exactly my question, because the regulation is not driving the markets towards that direction, right? I mean, you see very few banks that can actually meet all the Basel III requirements, that can meet all the... So when you design the regulation, you have a final product in design of the market infrastructure, but it's not really achieving that. What are the other risks?
No, but I think a lot of time is spent. I'm not saying all regulators, and I'm saying there's a complexity with so many regulations, but definitely we're very aware of, small firms wanting to enter and that there are no barriers of entry from the regulation. Now, it might turn out that there is, okay, because it's very difficult for them to model some of these things. But if they can't model it or move on to, say, AIRB or in Solvency II, implement proper economic capital models, then maybe they should rethink, what they want to be in. But they might still have a good role. They could be a community bank. In the US, community banks have blossomed. They're the highest growth bank. They don't take, massive risk, etc. Instead of lending, they might go out and outsource it or broker it. So there are lots of business models for smaller players. But I don't think that smaller players are capable to run derivative books, etc., to run anything complex. Even commercial real estate, I regard as extremely complex.
I mean, there are some carve-outs, I want to, in EMEA in terms of clearing, because if you're below a certain, if transactions are below a certain threshold, or if you're a pension fund, I think initially, for EMEA, which is making you, if you do derivatives, you have to clear. If products are clearable, they're saying, for lower value and certain types of players, there'll be carve-outs, so you won't have the extra expense of doing that. So I think there is some recognition, some regulation that there is this potential sort of barrier to entry, and trying to sort of balance that between obviously making sure that the right sort of risks are catered for and accommodated via the clearing mechanism that's being put forward as a solution, and also trying to sort of reduce some of the negative effects on barriers to entry. Whether it'll actually work or not, I don't know. Maybe a lot of people who were doing swaps might decide not to do them at all because of the extra complexity and the extra cost associated with having to, if they do go above a threshold, get themselves a clearing member and do that, who just does that clearing with the clearinghouse for them. That's an extra expense they may not have had if they've been doing it bilaterally traditionally with their broker. So some of the models will change, but I think there is some recognition that it maybe needs to be tweaked to make sure that pension funds aren't completely blown out of the derivatives business because of the new mechanisms that are being put in place.
We're running low on time now, so I think that's a good point to end on, though. But before we do, I just have a common question that I always ask every panelist, and given I missed their introductions earlier, I thought I would have each person, starting with Sebas, to maybe give a little bit blurb on your background, and then let us know what really keeps you up at night and what you're worried about for 2013. If there's one particular challenge or just a big implication that you think is particularly important in your sector.
I'm not really worried. I'm very interested to see how Solvency II is going to assess sovereign credit risk, especially in the EU. So at the moment, European insurance company holding European government bonds doesn't have a capital requirement for those bonds. It's only a capital requirement for the mismatch that you have. So suppose that your liabilities have a different sensitivity to change in yields than your assets. So I'm quite interested to see how Europe is going to solve this, because how the current Solvency II framework works is that you value your liabilities based on a swap curve, which is actually the same across Europe. Then you have a whole bunch of southern European insurance companies investing in southern European government bonds, which have devalued a lot. So I can imagine that those countries have negative services at the moment. And to make the whole framework feasible within Europe, I think there needs to be some kind of adjustment made to that. I'm also quite interested to see how we're going to ensure that Solvency II, or the idea of risk assessment, is also implemented in other places in the world. US is quite interesting now because they don't use this risk framework, but they use more like a factor-based approach. As a result, they actually have to hold less capital requirements most of the times, which actually means that you also can price your products more cheaply. The question is, like, if you are a global company and you want to implement something across the board, then you also have to price it in your products. And the question is, like, okay, will US companies then be able to compete? How are you going to solve this? So the two main things that I'm curious about.
Fantastic. And Richard, what about SWIFT in your point of view?
Well, as I mentioned when I did do my introduction at the start, one thing that we do is connect our institutions, the banks, to financial market infrastructures, and by that I mean payment systems, RTGS systems like CHAPS, CSDs like Euroclear, clearinghouses like LCH. So financial market infrastructure are obviously very central to some of the operational solutions, some of the regulation questions that we've been talking about. So in terms of our responsibility towards those institutions, and also to our bank and other financial institution users who use us to get to those institutions, so they can do their clearing, or they can settle their securities trade, or they can make that high value payment via the payment systems, making sure that what we do around that space particularly, which is becoming increasingly important, meets our users' expectations. So I think financial market infrastructures and what we do around that to make those transactions happen and those platforms accessible, that's my priority this year.
And what about you, Colin?
Well, you asked me what keeps me awake, so I'll just say that I've just got 3 issues. I mean, obviously we've spoken a lot about regulation, etc. The one issue I think that is going to be a major challenge for society is longevity. As you see, there's an aging population, etc. Well, firstly, I'm not sure that life insurance companies are going to be able to manage the fat-tailed risk of that longevity. I look at a country like Japan, and Japan is the second or now the third largest economy, probably $6 trillion, and it is shrinking. And the reason it's shrinking, it's been in a depression for 20 years, is something of what could happen maybe in other countries, and that is that the young, there are not enough workers to go into the labor force with the same level of productivity. So that's what's causing the Japanese bubble deflation that's happened. How they're going to get out of it? Well, one way is obviously immigration. Immigration is a way of bringing in labor. So I think the whole pension area, if you look at people, whatever, 65, 70, who have to retire, their pension funds are going to be worth much less at the moment. So how are they going to survive? So that's the first thing I'll just say, bringing in another area about longevity, aging, and demographics. I think that's a very important area. The second area, which we discussed briefly, was about the culture in the financial institution system. I honestly believe there needs to be a sea change. This year alone, I mean, in 2 years, we have blocked 70% of securitization transactions. So why were banks doing it? Because they read the rules and thought they could get away with it. What they did is they put securitized paper on their books and then they hedged it out with index derivatives. And it turns out, because of the formula that we use through Basel, through the supervisory formula, they could get away with less capital rather than looking at significant risk transfer. This suggests to me that people are still gaming the system. I think gaming should be removed. It should be illegal. I think things like even tax avoidance. I've now, there's a different appetite for that. Because what's the point of society setting taxes? I'm not saying it's right or wrong, but you can fight it, you can vote in a democratic society, but to arbitrage it, etc., it's the wrong culture, it's the wrong paradigm for the next century. Third point is the chief risk officer, I think, at the moment, is still the chief risk measurer. He's not a manager. He just measures the risk as an afterthought. So banks decide, we're going to do this, we're going to do that, we're going to acquire this company, we're going to acquire that company. Well, right now nobody's acquiring that much. But then they go to the chief risk officer and say, well, measure it. This has got to be a wrong way. The risk measurer must become a risk manager, and managing risk is something very, very different. That means being part of the strategy of the bank. It means being part of the business model of the bank. So really, I would change the role of the chief risk officer to be responsible for the risk to the business model. So if you tell me this is our business model, we're going to build this portfolio, this is how we're going to fund it, etc. Question is it viable on a risk-adjusted basis, not just ROE? It's got to be something like, economic value added or RAROC, and furthermore, under stress conditions, does this model break down? That's what the chief risk officer should be doing, as well as allocating capital optimally to get the best business. Unfortunately, at the moment, the chief risk officer is more like the chief risk measurer. So those are my 3 things.
Okay, thank you. What about you, Jonathan?
Very quickly, 18 years at banks, 7, 8 years at investment firms, and the last 13 years in risk. I wholeheartedly go along with Colin's comments. I think risk has too often been a butler to a business head.
Serving liquidity.
Rather than
that's a
true
cartoon right
charge. Well, indeed, I'm afraid that was exactly the problem, that you have many smart risk people who knew exactly what the risk was, didn't come together at the top, and they wouldn't be listened to at the board. And so I think risk needs a voice, and I think that's the challenge. And the other one, I think Colin said, and others have said, is demographics, especially in this society as well. But Japan, my wife is Japanese, so I see it regularly. A very different energy level. It's still a very nice society, but a very different energy level to what it was when I was there in the 80s.
Last but not least, James?
I think certainly what keeps our clients up, and I guess by extension keeps me up, is the ongoing uncertainty. So, we're talking today about Basel III, but Basel III is only one part of the overall regulatory framework. And although I agree with the objective of most of this regulation, I think it's pushing in the right direction. I think the uncertainty is going to create a lot of additional work for the banks, some of which detracts their attention from actually starting to rebuild the economy. I think the European Basel framework has just changed in terms of liquidity, as we talked about at the beginning. That one needs to be transposed into European law. The European process is tortuous at best. That will continue to take attention away from the real risk management issues, and that's what is keeping a lot of clients up.
Okay, fantastic. Great, well I hope everyone's enjoyed today's event and found it useful and informative. But I want to thank our speakers for sharing their insight and expertise with us today. So please join me in
just one last thing for 30 seconds of your time. Speaking of keeping you awake at night, I repeat again, Tom Wilson is the chief risk officer at Allianz, which is a firm that has done an extremely good job of managing its risks, and he's done a tremendous amount of research around model risk. So tomorrow afternoon at 4 o'clock at the law school, all of you from UCL will know where the law school is on the way to 2 blocks away from here. 4 o'clock, I think it'll be a very interesting 1 hour, and Tom has actually detoured from Zurich to come here and speak to us, so I hope you can join us tomorrow evening.
Now, if you want to follow us to the Moderator or discounts, if you don't know, it's like on your way to Topic Control on the left-hand side. So,
thank you very much.